Paul Wassmer will be talking about ways that people can maximize and protect their financial assets as they plan for retirement. Paul specializes in financial, retirement, and estate planning. His firm, Freedom Financial Services, currently has 4 offices in the Kansas City metropolitan area. The firm assists people in protecting their assets and helps them in a practical way to achieve growth and financial freedom. That is the short version. I have to say that Mr. Wassmer has been involved. It has a very, very varied background, including a background in nuclear physics and working with nuclear energy. And really, he's going to be coming back to do a webinar for us on energy and nuclear energy and alternatives to what we have currently today. His bio is on our website, but I'm just going to add that Paul and his wife, Rebecca, also have a nonprofit ministry called Crisis Pregnancy Centers of Kansas City. Over the last 20 years, this ministry has intervened to help save the lives of almost 10,000 precious babies. Paul and Rebecca have 5 children and 6 grandchildren. Again, it is an honor to have Mr. Wassmer on, and I'm just going to hand this over to Dr. Marvin.
Thank you, David. It's a great pleasure for me to introduce my dear friend, Paul. He is my financial advisor, and so with great happiness, I want to share some of what he has told me and taught me with the rest of the world. So, Paul, it's all yours. Take it away.
Dr. Marvin, thank you very much. It's an honor and a privilege to speak to your webinar attendees, and I hope this will be very fruitful and be a blessing for each one of them. The name of our workshop this evening is The Financial Path to Prosperity. I certainly agree with the comment that your financial stability, your financial safety, if you will, has a great deal to do with your emotional well-being. And we've noticed a huge impact on people that we've talked with over the last 18 months. 2008 in particular is one of the worst financial crises that this country has ever been through, has ever faced. And millions of retirees have lost, at the very bottom, several $1 trillion in net assets in their portfolio values. That's created a great deal of emotional distress. And some of these losses are so large that it'll take years, and in fact, some retirees may never recover all their losses. So I think this topic is certainly timely. And I may ask Dr. Marvin, do you anticipate, what's your own opinion as a retiree? Do you feel like we're going to have further market volatility, or do you think we're going to see stability from this point going forward?
No, we're going to have further market volatility, I'm quite sure. The new book, Aftershock, I guess is becoming a #1 bestseller because I heard it on radio tonight and I've heard it on TV, the promotion of the book Aftershock. And no, I think it'll have a lot of volatility.
By the way, as we started into the seminar, since we're using telephone connection, is there anything further I need to do to make sure listeners can hear us? Do we have confirmation that we're on with listeners?
Yes.
Okay.
Yes.
Absolutely.
You're being heard.
Okay.
Absolutely. Everything is going fine.
Okay. Well, let's see. Go to the next slide. Now, let's start with the definition of financial planning. Basically, the definition is making sure the financial path you're on is leading you to the destination you want to go. Making sure you're on a path. So the very first step in financial planning is clearly understanding each individual person or couple's objectives for their retirement. We need to understand the relationship with their money. We need to understand what's most important to them. But of course, there are some commonalities. Almost without exception, everybody, when we do a personal intake in that initial consultation, we find that nearly everyone is concerned with making certain that their assets and their income last for their entire lifetime. And that's the crux that we're going to talk about today, is income security and how to protect your assets in a way that will ensure that you don't run out of assets, if you live longer than expected. I'm having to do the manual advance here.
By the way, while we're waiting, I want to say those that want to ask questions, look on your right side of your screen to chat and type in the message here as a little window, and then you send it, and then we'll ask Paul what you ask for questions. So you can ask questions, and please do.
Now, I'm going to preface this next slide, the financial crisis. The federal deficit that we are experiencing right now may in fact create a very long period of recession. And, you know, already we've flirted with depression. We've avoided it at the present, but there are some macroeconomic things that are occurring right now that could cause us to go back into recession or worse. First and predominant is the commercial crisis. We have a huge default rate in commercial real estate that is starting to unfold. In fact, there was about 6 months ago on 60 Minutes, one of the top firms who analyzed both residential and commercial real estate were predicting that in 2010, 2011, 2012, we're going to have an enormous default rate on commercial properties like shopping centers and newly constructed apartment and condo complexes, and that'll have a huge impact on our economy. The other thing is the projection is we'll have about 1 million more home foreclosures this year than we did last year. Last year we had about 2.5 million. This year the projection is that we'll have about 3.5 million homes foreclosed. And then of course the very serious problem of unemployment. We may have actually unemployed, this is a little bit different than the government statistics, but as many as 15 million Americans who are unemployed. Apparently when you run out of your unemployment benefits after having been on unemployment for a year, at that point, if you haven't found employment, the government considers you to be a discouraged worker. It doesn't include you in that nearly 10% unemployment rate. So because our economy is not creating even a break-even number of jobs, which currently we need to create about 150,000 jobs per month in order to break even or to meet the needs of all the new folks entering the labor force from high school and college graduation. So we're not creating that kind of jobs, you know, anything close on a regular monthly basis. So the unemployment rate, this is an article in the Kansas City Star just last week, will be very high for the next couple of years. We may get down into the mid-8s at the very best, 24 months out. So, but probably the biggest problem that we face is this federal deficit. If you notice, kind of going off to the left of this PowerPoint slide, we had a $70 million debt, War of 1812, $1.2 billion debt after the Civil War, $6 billion after World War I, $26 billion after at the end of the Great Depression, $114 billion World War II. Currently, most people know we're in excess of $12 trillion. But here's the most sobering statistic. At the current rate of increase in our federal deficit, we'll be about 250% of gross domestic product by 2040. And that's just an unbelievable number, 250% of GDP. Right now we're about 60%, so we have to make a change in the direction of our federal deficit. One of the best resources in the country is David Walker. David Walker, I had the pleasure of being with him at a workshop in San Diego at the end of January. David Walker was the former comptroller of the United States from 1988 to 1998. He retired, and now he works for the Pete Peterson Foundation. He's a bit like Paul Revere. He's giving seminars, workshops. He's published a best-selling book, IOUSA. He also has a website, iousa.com. And on that website, David describes in great detail, like no one else could, because he was the one that signed the federal budget for 10 years. The reason he resigned in disgust, he felt like he could no longer continue to sign those budgets because there was so much misinformation and misdirection, kind of off-books accounting, that he no longer felt he could serve in that capacity with any kind of integrity. David helped us to understand, and for the listeners, there's a website you can go to called usdebtclock.org, usdebtclock.org. If you go there, you're going to be a little surprised. There's the debt that the government admits to, but there's another debt called unfunded liabilities. And when I say unfunded liabilities, Dr. Marvin, what do you suppose I'm referring to?
That's liabilities we've made commitment to that we have no way of paying.
We have no funds in escrow to pay those, and no income. The current taxes we're collecting. I wonder, most people may have heard this in the news, but I want to kind of reiterate it. It was recently announced that the checks being written to each and every Social Security recipient, those checks, they amount to a larger outgo of cash than the taxes we're collecting from FICA, from the Social Security deductions from working people's paychecks. So Social Security is actually in deficit right now. But if you go to usdebtclock.org, what you'll find is that the unfunded liability for Social Security is about $14 trillion in deficit going forward. Unfunded liability simply means all those Americans who have not yet qualified, not old enough yet to qualify for Social Security or Medicare, but someday will hopefully, qualify for that program. So, but on the other hand, Medicare is a $75 trillion unfunded liability. I found it interesting, Dr. Marvin, the Social Security is $14 trillion in unfunded liability. The new prescription drug plan is $18 trillion in unfunded liability. You had all those different, isn't that
and that's
shocking?
only a few years old.
That was passed in the Bush administration just not too long ago. But the reason that unfunded liability is so large is there was no particular funding mechanism. It was just another obligation the government undertook without having any way to fund it. And so I'm not passing on judgment on whether the prescription drug program is a plus or a minus, but it is a net minus for our economy because it's not a funded liability.
Right.
All said, when you go to usdebtclock.org, you'll find unfunded liability exceeds 107, I'm going to use that T word again, $1 trillion. To put it in perspective, Newsweek had an article about, just exactly what it means to have $1 trillion. For example, if I had crisp $1,000 bills, and that crisp $1,000 bills was a stack 4 inches high, I want you to guess, Dr. Marvin, how much money would that 4-inch stack of $1,000 bills represent? 4 inches high.
4 inches high? Well, they'd have to be pressed pretty good. But I would say probably $1 billion.
No, actually that's $1 million. $1 million is 4 inches high.
Wow.
Now, to have $1 trillion, which our government is throwing around this $1 trillion this and $1 trillion that, 1,000 bills, crisp new bills, 67 miles high would constitute $1 trillion.
Wow.
67 miles. $1 million is 4 inches high. $1 trillion is 67 miles high. Another kind of put it in perspective, 1 billion seconds is 32 years. How long do you suppose 1 trillion seconds is?
Well, Jesus was still alive then, I imagine.
Well, it's 32,000 years, 1 trillion seconds.
Wow.
So these numbers are almost beyond calculation. But at the rate of growth of our federal deficit, the thing that we have to be concerned about is deficits cause, first of all, much higher taxes. And one thing that we can be sure of is 9 months from now, we have a large increase in our tax rate. In fact, those Bush tax cuts from 2001 expire on January 1st, 2011. You know how there was a 25%, many middle Americans are in the 25% tax bracket. That bracket creeps up to 28%. And then it goes to, and the 28% goes to 31%, then 36%, and the top rate goes to 39.6 from its current level of 35%. So we have significant increase in taxes here 9 months from now. The maximum capital gains tax rate will rise to 20% from 15%. And Dr. Marvin, you're probably familiar with the special tax break for dividends that we've
Right.
had the last several years. That ends. And so instead of a very modest tax rate on dividends, now they'll be taxed as ordinary income. So if you're in the 28% bracket, every dividend you receive will be taxed at 28%.
Wow.
So when we talk about higher taxes, that is not something that is certain, because if Congress, I don't know if you can imagine this scenario, can you imagine a Congress that should get something done in this area? Can you imagine a Congress that didn't actually get it done? Actually, with
Yes, I can.
a significant problem like fixing Social Security or fixing Medicare, they've been kicking that can down the road for over 20 years. I can imagine a Congress that will take no further action. And if they don't, these taxes or marginal tax rates are going to go up here in 9 months, without a doubt. It's a sunset provision from the original Bush tax cuts. The other thing that these massive deficits are going to cause is inflation. Now, one of the things we know is incredibly inflationary. Let me use an example. Under the Carter administration in the 70s, there was a prevailing school of thought that we should expand the money supply to try and address the kind of the recession that they were in then. They expanded the money supply by 13% a year for 2 years in a row. They expanded the federal money supply by 26% over 2 years. Now, who do you think they brought in to fix that massive inflation that followed increasing the money supply? They brought in Paul Volcker.
Yeah, right.
In his 60s. Now he's in his 80s and he's back. He's been brought in to help address some of these same kind of financial problems, like inflation. The only problem is, in the fall of 2008, in a 4-month period, Dr. Marvin, the money supply was expanded by 130%. The government expanded the money supply by $2.5 trillion. Now, the biggest previous expansion of the money supply in our history was $500 billion. They went 5 times that much to $2.5 trillion. When you basically circulated a lot of extra bills in the economy, what do you think that's going to produce?
Inflation.
Massive inflation. The only thing that's holding back, restraining inflation in any way at this time is our large unemployment. Our economy, 70% of our economy approximately, is based on consumer spending. Having a massive 10% unemployment rate, or 9.7, whatever the current number is, massive unemployment rate, consumer demand is rather weak right now. So as employment starts to recover, then I think the chickens are going to come home to roost, so to speak. That massive increase in our money supply is going to be inflationary. The only thing that restrains it right now is at one of the lowest overnight lending rates from the Fed in the history of the country, hovering, around between 1/4 and 0.5%. Extremely low, cheap money. And the government over the last 14 months has purchased $1.2 trillion in mortgage bonds, also to keep interest rates supernaturally low. But that stopped April 1st. I don't know if you knew that. But those purchased by the federal government of mortgage bonds ended April 1st, 2010. So we think interest rates are going to start to drift up. So as jobs recover and as the economy starts to recover, I think we're going to see very, very significant inflation. I hope it's not as bad as the Carter years, but I think there's a chance that it really could be. Now, on the next slide, we want to take a look at the federal indebtedness that our government has undertaken on behalf of all taxpayers to kind of address the financial crisis in 2008. This Wall Street bailout and the bailout of our economy, various financial institutions like Freddie Mac and Fannie Mae, the bailout cost $8.5 trillion. Now, it's interesting, if you look at all the wars we've fought in since the American Revolution, that $8.5 trillion is much, much larger than the total cost of all U.S. wars up to this point, including Afghanistan, Vietnam War, the Persian Gulf War, etc., Iraq. All those wars combined are much, much less than the bailout of Wall Street and the bailout of various institutions that have occurred in the last 18 months. So again, inflation. So the question becomes, how does that affect the average retiree? We'll be getting into that. Strategies we can employ to help counteract or at least be prepared, maintain our inflation-adjusted income in the face of this increasing inflation, increasing taxes. We'll return to this debt clock, this next slide. Do you see that, Dr. Marvin?
Yes, I sure do.
National debt, $2.5 trillion. Per taxpayer, that's $114,000 that's due from each and every taxpayer.
That's 12.5 trillion.
12.5 trillion.
Right.
So that is just a shocking number. And again, if our webinar participants would go to usdebtclock.org, they'd see all the different categories of debt, including that unfunded liability we were addressing just a minute ago.
I saw a cartoon, Paul, just yesterday that showed a little girl with her dolly, and she said, "All I own is a dollhouse, but I owe $40,000.
Yeah, that's true. Per citizen, that's exactly right. The debt, the average cost per citizen. So if you're a family of four, the four added together come to $160,000 that are due by each member of that household.
Right.
That's a shocking number.
It is. You didn't mention about when did the U.S. pay off their war bonds for World War II?
I saw a news item here recently that we as a country had just finished paying off the last of the World War II war bonds that were issued back in the 1940s.
65 years.
65 years ago.
Right.
And that debt was very, very small compared to our current debt. We saw in an earlier slide that was just a fraction of our current debt, the World War II debt. It was measured in billions instead of trillions. We just now paid that off 65 years later. I can't even imagine whether it's going to be our great-grandkids, our great-great-grandkids are going to be paying for some of the federal indebtedness that we've undertaken. So the good news is we've dodged a depression, in the last 18 months. I think the bad news is, Dr. Marvin, that
yes.
we did so by putting an enormous amount of money on a credit card, so to speak, by undertaking a massive amount of debt.
Absolutely.
I also read here recently that Standard & Poor has been hinting or intimating that they are considering lowering the U.S. dollar, the rating on the U.S. dollar from AAA to AA. The U.S. dollar has been the world's reserve currency and has had a AAA rating since 1917. If we stopped being the world's reserve currency, and if our rating goes down, the cost to finance our debt, to borrow money from China, India, Great Britain, Japan, etc., the cost for borrowing that huge deficit of $1.5 trillion, which is, that's the kind of deficit our government is projecting for the next several years. That's the amount of money they intend to spend, in other words. One way to avert it would be to cut the spending, correct? But it doesn't seem to be any kind of option as far as restraining our spending. Our Congress seems constitutionally incapable of doing that. But the cost to finance that debt will become enormous, much larger than it is now. And in fact, in not too many years, about 15 years down the road, the projection is that we'll be using every discretionary dollar we've got in the budget just to pay the interest on the debt.
Right. I heard it was as much as 785 trillion 15 years down. Billion. 785 billion
interest
each year.
On the debt.
Just
that wipes out, all the discretionary spending that there is in the federal budget. Another measurement of the financial crisis we've just been through is volatility. The VIX index, we had in the fall of 2008, we hit volatility numbers in the stock market that have never been recorded before. We set records in the VIX. And from a year ago, March of 2009 to March 2010, that volatility index, if you'll notice in December, had fallen below 20. Well, since that time, notice how it's gone up again in February and March, and it's well above about 25, 26, 27. So volatility is increasing once again.
Right.
I think volatility is going to be a standard feature of our markets for quite some time to come. So we got to keep that in mind when we talk about strategies for retirees. In fact, I think many of our fellow American countrymen have felt like they've been riding this crazy roller coaster, because in the last 8 years we've had not one but two massive meltdowns in our U.S. markets, our equity markets. In 01, 02, one of the widely used indexes, the S&P 500, because it represents the 500 largest companies by market capitalization. The S&P 500 dropped from top to bottom 46.5% in 01, 02. And many of our retirees took massive losses then. They recovered most of their losses. In most cases, they recovered their losses, not enough to keep pace with inflation, you see. During that period from 01, 02 to present, when people look at their portfolios in 2007, their portfolios were not even with inflation over that previous 7-year period from 2000 to 2007. But they had recovered at least most of their losses, not counting inflation, only to have, from the very top value on October 9, 2007, Dr. Marvin, at 1565 in the S&P, went down in March of last year to 888.
Right.
We dropped from top to bottom 56.8% sell-off in the equities markets. So a lot of folks are just feeling like they're on this crazy ride, and a lot of people are have lost a great deal and are just paralyzed by their losses. Now we're going to talk a little bit about behavioral economics. One of the things that people tend to do is called confirmation bias. Basically, people look for information that confirms their decisions, not conflicts with it. So when they make a decision, buy a particular position or buy a stock or buy a position in the market, they look for reasons to hold on to that stock. These are some of the reasons our retirees are losing the money game, and a lot of Americans are losing the money game. Another thing is, General Motors is a fine example. I had talked with General Motors retirees that had a bunch of GM stock in their portfolio, over the last several years. My advice was always move out of that. You're never going to see GM back at its glory days, at its height. And some of those folks held on to the bitter end. We know what GM bondholders, what happened to them in this takeover of GM, right? They're the ones that lost everything. Short-term memory syndrome. I've seen that a great deal, where folks remember, for some reason, they don't remember the huge sell-offs in the market. They remember, the gains they've had, for example, over the last 12 months, and they tend to forget the massive losses they took 18 months ago. So that's another thing that works against sound decision-making. And then status quo bias, kind of decision paralysis, where because you've had this stock for so many years or held on to this position so many years, you really have a tendency to stay at rest. You avoid making changes. That feeling of paralysis, where you had a telecommunications stock that was worth $40,000 when you bought it, and now it's $20,000. How many times have you heard from so many stockbrokers the refrain that you need to hold on, it's going to come back. Hold on to that position, it's going to come back. Or, basically wait on the market, and they ride that position down to where it's worth almost nothing. So the events that have conspired over the last 18 months have caused a lot of people to feel kind of paralyzed, unable to make a change in their situation. The other thing is there's so many choices that we're faced with when we talk about investing. There's over 6,000 stocks. There's over 10,000 mutual funds. There are so many different choices of bonds. So sometimes people feel overwhelmed. When they have too many choices, they end up doing nothing at all. These are all aspects that work against winning the money game when it comes to protecting your retirement dollars. Now, one of the folks that we've been following, somewhat closely, Harry Dent, is a Harvard economist. He is a best-selling author. One of his favorite statements about the stock market is, as it relates to folks that have no more earned income, they're retired, they've accumulated their assets over many years, perhaps 4 years, At that point, the priority becomes preservation of capital, preservation of principal. Harry Dent says not losing money in this current market is more important than making money. Keeping what you've got. In fact, I've seen so many examples individually when we counsel with people that if they just had the funds they had at the beginning of 2000, speaking to them, of course, in 2003, when their portfolios are much smaller, and again here in 2008 and 2009, people realized if I hadn't been exposed to so much risk, if I just had the dollars I had in 2007, I'd be perfectly fine. The fact is, because I'm 30 or 40% below where I was, all of a sudden I have real issues about whether I'll outlive my money. I really recommend Harry Dent's book. He has, this one is, the book that I like right now is The Next Great Bubble Boom by Harry Dent. The reason we give some credibility to Harry Dent is he wrote in 2007 a best-selling book called The Great Depression Ahead. He predicted in a hardcover book, textbook, best-selling book, this huge financial meltdown that occurred, in 2008. Talked about major institutions disappearing overnight. We didn't actually slip into a depression, but the reason for that is we put an enormous amount of money, on the debt ledger and basically, delayed our pain for another generation. So someday that massive debt is going to have to be paid back, but we basically delayed that deleveraging of debt by massive federal intervention. And all of that borrowing, from China and other foreign countries comes with an enormous price tag. We're going to pay enormous interest to borrow that money. So, but most of what Harry Dent predicted in 2007 has actually come to pass. His prediction about the U.S. equities markets is that we won't see a stable growing market of any consequence till the mid-decade, around 2015. In the short term, he's predicting massive volatility and another major correction. And particularly in the next 6 to 12 months, he's saying on his website that we'll see a major correction. So because he has been right a couple of times before, we pay a special, make special note of whether Harry Dent publishes. Another aspect of behavioral economics is, and this is kind of augmented by the typical broker-dealer. A lot of stockbrokers, when folks, I've heard this recounted to me both from the sell-off in 2001 when the markets are dropping precipitously, dropping every day, every week. People are calling the broker saying, shouldn't I move my money, protect some of my money while I still have some? What do you think most people heard from their broker? Too many people heard from their broker. What do you think the broker told them to do, Dr. Marvin?
Hold on. It'll come back.
Yeah, hold on. Wait on the market, and eventually it'll work out. Well, someone who stubbornly holds on to a position and lost 50% or more, sometimes the best thing to do is cut your losses and reposition your money while you still have some. But a lot of people hang on to their investments until they're worth almost nothing, hoping for that automotive stock or that telecommunications stock to come back. Sadly, that's not the case. In many cases, that's not a good strategy. Because the one thing that's a constant every day, every week, every month is, we do have inflation. One thing that I share in our workshops, if we look at January 2000 to January 2010, whether you have $100,000 or $1 million, you had to have about a 34% increase in the value of your savings and your portfolio to keep pace with inflation. U.S. Department of Labor said we had 2.99% compounded inflation over the last 10 years. Well, very few equities portfolios have kept pace with inflation. In fact, if you look at the S&P index value 10 years ago on January 1st, 2000, and look at the index today on January 1st, 2010, exactly 10 years later, the S&P index is negative 22%, 22 and a fraction. So that means if you had $1 million 10 years ago in a Vanguard 500 fund, you sold that fund today, your net market value at the date of that sale would be about $780,000. So a negative 22%. you needed a positive 34% to overcome inflation. So folks that were in investments that were earning as little as 3.5% kept pace with inflation. But those that are in the market, actually, they're down 22% if they were fully invested in a portfolio that was like the S&P 500. And by the way, Dr. Marvin, if I were to ask you, of all the money managers on Wall Street, do you think the majority of those money managers can prove, with Bloomberg or Morningstar, prove that their portfolio performance, their management, is better than the average gain for the S&P 500 or worse?
Worse.
Considerably worse. I mean,
yes.
Only a relative, the very small minority can prove that their portfolio performance, their management, exceeded the S&P 500. Most lagged the S&P 500 performance. So if that acts as kind of a proxy or a metric to measure the overall U.S. stock market, it represents the majority of the value of the entire U.S. stock market, those top 500 companies. Then if you're down 22% over 10 years, and you needed to be up 34% to keep pace with inflation, I call that the gap index. We get the difference between what we got if we were fully invested in the market in equities versus what we needed. The difference between what we needed and what we got over the last 10 years is about 56%. Now, what do we call that? That's a massive problem, a massive shortfall. So we have to look at ways to reconstruct or reallocate our portfolio, because if anything, I think inflation and issues like taxes are going to be more pressing over the next 5 and 10 years than they've been over the last 10 years. So let me talk about the 3 phases of your financial life. Now, this is a little difficult to do because we don't have a whiteboard to do this on. But Dr. Marvin, if I were to take a tape measure and start at one end of the board and run that out to, say, we're talking to a typical 65-year-old, 65 years later, we mark, because that person is just now retiring, we mark a place on the board, 65,
right,
65 inches, and then we ask, at 65, what's the average life expectancy? As a doctor, I'm sure you can tell me. What do you suppose the average life expectancy is for those who reach the age of 65 here in this country?
I think it must be, is it 80?
Well, it's actually the U.S. Center for Health Statistics. It's gotten a little better. It seems to get, I've heard this metric that it improves by 8 months every 2 years, that it's been inching upward. Without reference to gender, the average American lives about 83 or 84 years.
Right.
Now, if we get into gender, the ladies beat the men by about 2 or 3 years. They live just, about 3 years longer on the average. But if we're 65 and we look at that lifespan, 65 years, and we're looking ahead and we've got maybe, not quite 20 years, 18 years of longevity ahead of us, what's the one missing element in terms of that portfolio? What one critical factor do we lack?
Guaranteed income.
Well, that's right. Well, in terms of being able to absorb market volatility, market losses, we lack time.
Right.
We don't have the time to ride that roller coaster and to recover from big losses in the market. So how we allocate our retirement savings, our retirement portfolio, is crucial. And I'd like to offer this to our webinar participants. If they contact our office, we'll have contact information at the end of our workshop this evening. There's a report by Dr. David Babel, Professor David Babel, PhD from Wharton School of Business, and also Professor Craig Merrill. And the title of this 10-page report is called Investing Your Lump Sum at Retirement. It's a very scholarly report. I hope most people have heard of the Wharton School of Business. It's one of our finest business colleges. What is lesser known, it's also regarded as one of our top financial planning and retirement planning colleges in the nation. And in this 10-page article, I'll offer anybody that would like to have it, I'll be glad to send it to you. Send me an email or call our office. We'll be glad to mail that out to you. But Investing Your Lump Sum at Retirement, it talks in length about how you allocate your assets when you stopped having earned income. Kind of a summary of this 10-page article, Dr. Babel and Dr. Merrill are saying that for that part of your portfolio that you need to generate guaranteed income, what you just said a minute ago, that issue about having a guaranteed income.
Right.
That part of your portfolio you need to generate guaranteed income, the principal that's required to generate that income has to be protected from any losses. And you have to have enough built into the plan to provide flexibility to also provide inflation adjustments for inflation to make that income increase as necessary to keep pace with inflation. This is a masterful article from the Wharton School of Business, and these are two of the preeminent professors in the field, and they've written a marvelous 10-page report on exactly why you put the majority of your portfolio, that part you need to have guaranteed income, in a posture where you can't lose principal. And then, of course, it becomes the job of a financial and retirement planner to come up with a customized a correct mathematical algorithm, a correct mathematical plan to provide that guaranteed income for the rest of that client's life and to provide flexibility in that plan to adjust that income for inflation. Everybody should have a customized plan for income, a guaranteed plan. And here's what I found, Dr. Marvin, that's so rare. It's one of the most important issues for retirees, stability and peace of mind. It's part of that overall concept of health. If you have financial problems, David was talking about that at the beginning. If you have financial issues, financial shortfall, then that can create real emotional and mental stress and also cause you to be unable to pay for some of the necessary things that you need, health care or long-term care. Those are all things that can really seriously impact your quality of life, and being able to pay for the care that you need, medical and otherwise. And so this is a crucial issue. Everybody should have a guaranteed, customized plan to guarantee your income, inflation-adjusted income for the rest of your life. Do you know how many people at our workshops actually can verify that they have a plan that's been created for them? Very few. It's surprising, really. But this 10-page report talks about how crucial that is. Everybody needs to know exactly what their income number needs to be and then project it for various levels of inflation and have a guaranteed plan to meet that need. The three phases of your financial life, the first, usually about 60 or 62 years, is accumulation. And of course, some of the things that you can use to accumulate assets, see a couple things missing here. You can use real estate, use stocks, bonds, mutual funds, variable annuities to accumulate assets. But now to preserve, that preservation stage comes when your earned income stops because you have no way to make up for losses. If you lose part of your savings, part of your investment portfolio, you have no way to really make up for that. You're kind of at the mercy of the markets at that point. So we shift from accumulation of assets as we get into our 60s to preservation of assets when we actually retire, using safe money vehicles like CDs or fixed annuities, fixed index annuities. Some people use variable annuities, although those are usually less satisfactory when you're retired. And then the final stage is, planning beyond your own lifetime for your loved ones, for your children, your grandchildren, your favorite charity. Or use strategies like Stretch IRA, or in some cases Roth, converting your IRA, your qualified money to Roth. We're going to have a special seminar just on Roth conversion upcoming on a different date. Estate planning, charitable planning. One thing that's going to affect many, many of our folks that are participating here today, I know it affects about 17,000 people, 17,000 households in Kansas City alone. What happens to the estate tax, Dr. Marvin, on January 1st of 2011? Are you familiar with what's going to occur to the limits, how much your estate will be exempt from estate taxes?
Be very little, I imagine.
Well, you're exactly right. Currently, it's been, for 2009, the limit was $3.5 million per person, or $7 million for a married couple. So that means the first $7 million of a married couple's assets would be exempt from that 46% estate tax. But if you had assets bigger than $7 million, not many people do, but if you had, say, $10 million, the last $3 million above that $7 million exemption amount would be subject to a 46% tax. And if you add the state level estate taxes to that, about half of that $3 million would be due in taxes by the beneficiary. Well, guess what happens in 9 months? Those limits drop dramatically from $7 million down to $1 million per person or $2 million a couple. That happens in 9 months. That's the sunset provision. That's part of the changes in the tax law from 2001. Those limits go back to their original, much lower levels. And the TARN rate goes up from 46% to 55% of the amount. So if you have $3 million for a married couple and the limit is $2 million, that last $1 million will owe 55% or $550,000 in estate taxes. There are ways to plan for that with charitable lead planning, charitable trust, charitable lead trust, charitable remainder trust, family limited partnerships. And that's something that a good retirement planning firm can help that client with if they suddenly find with this change in the estate tax laws coming down to a much lower level that they're going to owe estate taxes. And of course, avoiding probate. You know, on a $1 million estate, probate costs can be $60,000 to $80,000, and you can take care of that with a pair of revocable trusts that would cost less than $1,000 to put in place. So these are all parts of the distribution phase of your financial life. Now, these are several of the issues on this next slide that, you know, basically we work with folks to help them avoid taxes. Taxes are going to be going up, and so reducing that taxable income is absolutely essential. A lot of people pay taxes on interest income they're not even using. So to recategorize those funds on your federal tax return from taxable to either tax-deferred or tax-free. Tax-deferred could be things like putting CD money into annuities where your money grows tax-deferred and doesn't create a tax for you each year, or in Roth accounts where the money is tax-free. Now, there's a new law that went into effect on January 1st, 2010, where folks have a special opportunity to convert to Roth. We'll talk about that now, discuss that in a little more detail. On Roth conversion, another way to avoid taxes, those folks who had income that exceeded $100,000 a year adjusted gross income were never allowed to convert to Roth until now. Now, every U.S. taxpayer has the option to convert their IRA money to Roth if it makes sense to do so. And there are quite a few different areas that have to be considered. It's a fairly complex topic. You have to look at a variety of issues to find out if it makes sense for each individual person to convert to Roth or not. But the government suddenly has had a change in posture as regards to promoting Roth conversion. They've created a situation where anybody that converts to Roth this year doesn't have to pay the first half of that the tax on that Roth conversion until their 2011 tax return, which means they actually pay the taxes in April of 2012, 2 years from today. And then they can pay the second half of the Roth conversion on their 2012 tax return, which means they don't actually have to write the check for the Roth tax conversion until April 2013. Why do you suppose, Dr. Marvin, the government suddenly becomes so interested in helping people convert their IRA accounts to Roth?
They receive more money quicker.
They're desperate for taxes. You're
Yes.
right. You're exactly right. They receive a massive infusion of new taxes. Now, I can tell you that analytically, it's not in the best interest of the government in the long term to allow people to convert to Roth. They would collect far more taxes over the next 20 years by disallowing Roth conversion, making people take the required minimum distribution. When folks reach 70 and a half years old, they have to take a minimum amount a specified amount out of their IRA accounts each year. By forcing people to do required minimum distribution over, say, a 15 or 20-year retirement, the government would collect far more taxes than they would on Roth conversion in most cases. So, but the reason they're not thinking of the long term, they're thinking of the November elections. They have this massive deficit, massive shortfall in tax revenues. One of the methods they want to employ to make up that shortfall is to promote Roth conversion. So people have as much as they have 2 years to pay the first half of a Roth conversion done today in 2010. They have till April 2012 to write the first half of that Roth conversion tax. They have till April 2013 to write the second half. So that's a marvelous opportunity for some people. It does require a certain amount of analysis, and we'll do a specialized workshop on May 11th to talk about all the different factors you consider, all the different mathematical computations have to be made to determine if it's in your best interest to convert your IRA account to Roth. Another thing that folks, particularly as they look at this increased volatility, one of the things that causes people to lose the money game, the huge fees they're paying in some of these instruments. An example might be the huge operating fees in mutual funds. The operating expense fees, the 12B1 fees, oftentimes there's a commission when that mutual fund is sold, or there's an annual management fee, and if it's a C-share, a redemption fee. So the fees that people pay on mutual funds can be enormous. We look at other strategies. Our partner for managing money, Global Financial Private Capital, is an institutional money manager, and they like to promote, equities like exchange-traded funds, where the overall fees are about half the fees of mutual funds. But folks oftentimes don't understand the fees they're paying. Those fees oftentimes are very significant and work against their overall return. And of course, the other thing is the behavior of so many investors is to sell at the very bottom, like in 2008, liquidate their portfolios at the very worst moment, sell low at the low point in their portfolio, or the converse, buy when equities are very expensive, when they're at their peak. That tends to work against, the success of individual investors. So asset allocation is by far the most important part. The difference between the very best, money manager on Wall Street and the very worst, overall, that might, one statistic I read, an analysis of the markets, that might make a 4% difference between the top and the bottom money manager in terms of performance. By far the biggest factor is how to allocate your portfolio. How much money do you put at risk versus how much money you put in a posture where you protect and preserve your capital. Let's start with the definition of safety or safe money. Safe money is where your principal is protected from loss as long as you follow the guidelines. And if you decide to take your money and leave, you know pretty much what leaving early will cost. An example might be a CD. If you leave early on a CD that has maturity of 2 years or more, most banks charge an interest penalty of 6 months. It's a safe scenario. Sadly, right now, the tough thing is CDs pay such little interest that we have to look at other strategies. But we still have to find ways to protect and preserve capital. Now, one rule that we think is very helpful for people as they decide how to allocate their nest egg, their investment portfolio, is the rule of 100. If a person is fairly typical in their relationship, with risk of, what kind of risk they're willing to take with their money, then you basically start with your age. If you're 70 years old, then you subtract 70 from 100, and the answer, 30, is the amount. That's the maximum amount of risk that you should, maximum amount of your portfolio you should put at risk, where you have a chance of losing your principal. And 70 would represent the amount, that percentage of your portfolio should be beyond risk, where you protect and preserve your principal. You can't take a loss. So conservative allocation helps, but asset allocation is the key. And it's a little bit like building a house. Dr. Marvin, when you start to build a house, what is the most important part of that house for the overall stability of the structure?
Foundation.
The foundation. And so the foundation of any sound financial plan has to consist of the types of funds that can't be lost due to, changes in the market or the economy. So we start with conservative allocation with, things like CDs or savings or bonds, very conservative bonds. That forms the foundation, fixed annuities, anything where the capital is preserved. That builds the foundation of a good financial plan. In the example we just used on the rule of 100, 70% of that portfolio should be in categories where you can't lose principal. And only 30% would be categories where you could lose, things like stocks and variable annuities and other types of investments where you can lose principal. So that diversification, how you allocate your portfolio, is absolutely essential. Many people have common objectives. Most everybody wants to grow their money. Sometimes they need to generate income from that money. But at the same time, based on our sound financial planning rules, retirement planning rules, the majority of that portfolio has to be beyond risk. That's where we get into individual planning, customized planning, to create a scenario where you have rates of return that are big enough to overcome the combined impact of inflation plus taxes. In most cases, that means you need to have a return that's 6% or more, between 6 and 8% guaranteed return on your money, to grow your money fast enough to keep pace with inflation and taxes. So that's where we get into some of these new legal reserve accounts that carry those kind of guarantees, where your income account, your pension account, grows by, some companies guarantee 7%, some companies guarantee 8% increase in your pension account balance each year without putting any of your principal at risk. So those are key attributes in terms of meeting these criteria for not putting too much of your portfolio at risk, but not euthanizing your money either, where you're growing your money fast enough to keep pace with inflation and taxes. Now, Dr. Marvin, you remember earlier we talked about the debt clock.
Right.
At the beginning, this is just a snapshot over about this was a 60-minute period. You'll notice that the national debt went up $188 million in 1 hour. In
Right.
1 hour, our national debt went up $188 million. Is that hard to, for me, that's just hard to comprehend, that our debt would be roaring along, racing along at that speed.
I'm shaking in my boots.
Sir?
I'm shaking in my boots.
Well, I tell you, this portends major problems for us, for our economy and our stability of our, all of our workers and retirees. This kind of debt is the enemy of our financial stability, I promise you that. Now, let's talk a little bit about individual strategies. I'm not going to borrow from the seminar that's coming up on May 11th on Roth conversion, but Roth conversion is not for everybody. If someone is in a modest tax bracket, let's say 15% or less, then perhaps another strategy would be stretch IRA, where you're growing your IRA fast enough, first of all, to keep it growing faster than the amount you're taking out for required minimum distribution. And then how you pass those assets, those IRA assets, to your children and grandchildren, that multi-generational transfer. We'll talk about that. But the reason it matters is, statistically, about 90% of all IRAs are liquidated at the death of the surviving spouse. So that means we have to look at either stretch IRA or stretch Roth IRA. The main difference is, if you pay the Roth conversion tax on the front end, you're passing tax-free money that will grow tax-free, provide tax-free income, both for the life of your surviving spouse. It'll be tax-free income for your children. If some of those funds pass to your grandchildren, it's tax-free money to your grandchildren. So the question becomes, is it worth paying that big Roth conversion tax on the front end? A lot of it depends on your age at date of conversion, how many years you have left to overcome the cost of that Roth conversion, and also the tax bracket. But if you're in a lower tax bracket, stretch IRA is another possibility. Then strategic IRA rollout, that's simply recognizing that if we convert assets, IRA assets to Roth this year, and we say we pay all the tax next spring, we're going to be paying at a rate that I don't think any of us will ever see again. Most of the period of the baby boomers, those born from 1946 to 1964, a big portion of their lifetimes, marginal tax rates were as high as 90%. And then came the Reagan tax cuts, but there was brackets as high as 90% for a big part of our growing up years. I think, Dr. Marvin, we'll look back at the 90s and the first decade of 2000, when people say, I really was in the 15%, I paid 15%, or I was in the 25% bracket, or the top bracket was 35%. I think some of our children and grandchildren 10 years from now will say, no, Grandpa, really? Are you, seriously? You paid only 35%? I think it's going to be one of those, you can't believe it type of scenarios 10, 15 years down the road. So converting IRA money to Roth this year and paying the, even if you're paying at the top margin rate of 35%, that's that whole strategic IRA rollout. Paying the tax now at a lower rate as opposed to paying a much higher rate later through 15 or 20 years of required minimum distribution. We'll get into some of the numbers on that at that seminar on May 11th.
Yeah, and this is a special year.
It's a very special year because people have 2 years to pay the first half of the Roth conversion and 3 years to pay the other half. So it gives them a lot of time to grow their non-qualified money to pay the tax. That growth on their non-qualified, or what I call non-qualified, means their regular money, the money that's not IRA. The return on that non-qualified asset could be enough to pay the tax over several years. So having that extended period to pay the tax, in some cases, is quite helpful. Now, here's an example of this is an example where someone doesn't convert to Roth, but they do choose a stretch IRA scenario. Maybe they're in the 15% bracket. They're not getting hurt that bad on required minimum distribution, not paying an excessive amount on taxes, but they distribute money out of their IRA account. This example, Mr. and Mrs. Smith, 65 and 64, have 2 children and 2 grandchildren. We're starting out with an IRA balance of $525,000. Mr. Smith, over his lifetime, this is based on current actuarial tables, current mortality tables, will pay a required minimum distribution. This is also, Dr. Marvin, based on a 6% average rate of return.
Right.
We have plenty of examples of accounts that guarantee that. $525,000 in RMD on a $525,000 asset. So he'll distribute as much in required minimum distribution as he owns in terms of the original account balance. Then the balance at death, even after putting out $525,000, at a 6% return, he passes $838,000 to his wife, IRA account balance. She'll pay an additional $161,000 over her remaining lifespan on that IRA money. And then there'll be an $827,000 balance. Again, this is based on 6% rate of return and the regular aren't required minimum distribution tables that are required by the IRS. The balance to the heirs, $330,000 apiece to each of the 2 children, 40% to each of the children, 80% altogether, and then 10% to each of the 2 grandchildren, $82,000. That RMD for the 2 children is $1.2 million for the older one and $1.396 million on the younger one. The 2 grandchildren, based on the difference in their ages, have an RMD of $695,000 on that $82,000 balance and $726,000 because it's for the rest of their life. They're doing RMD on that IRA account for the rest of their life. Now let's go back to the original example, $525,000. By passing those assets to the children and grandchildren, we have total income distributed from the IRA of $4,747,000 over the lives of the children and the grandchildren. First Mr. Smith, then Mrs. Smith, then the 2 children, and then the 2 grandchildren. So that's a way to create an intergenerational transfer of wealth. The only thing that might make that even more exciting, if they're in a higher tax bracket and it made sense to convert that money to Roth, The income distributed from that RMD just means required minimum distribution. Everybody's just taking the minimum the government requires each year. You know, the penalty for not doing the required minimum distribution on qualified money, do you remember the size of the penalty, Dr. Marvin?
Yes, 50%.
50%. So that's a huge penalty. So the government's serious about getting their tax money, aren't they?
Right.
So overall, that's a way to create an intergenerational transfer of wealth, and in some cases, if it's Roth, then that'll be tax-free income. So that's a great strategy. Now, this is where you're passing the IRA asset, a multi-generational IRA or stretch IRA. When you're passing the lumps, instead of doing a lump sum and liquidating the principal and paying all the taxes all at once, it's passing it to the children with an instruction. Maybe it's done in a trust, maybe it's done informally, but it teaches the kids just to take out the RMD income, the minimum amount they can. They'll have that income engine for the rest of their lives and also for the lives of their children, the grandchildren. So you're creating a legacy of lifetime income for both your surviving spouse, children, and grandchildren. So if you analyze it, the difference between what happens so much of the time when the beneficiaries get that cash, the vast majority of the time they simply liquidate that IRA money, pay an enormous amount of tax because they did a lump sum distribution. Now, if you do a multi-generational stretch IRA, that can increase the amount distributed by as much as 10 times by passing that asset both to the children and the grandchildren and just doing required minimum distribution over their lifetimes. 10 times as much income. In that example we just gave, $500,000 IRA account at a 6% return can pay as much as $4.9 million over two generations. Now, the ideal IRA custodian should offer the following benefits. First, guarantee the principal of that IRA account. Second, guarantee a reasonable minimum rate of return. Third, administer the distribution of the IRA income distribution for the beneficiaries at no cost. And last, provide a binding beneficiary document that will control the distributions after their death. In other words, set it up in such a way that the kids can't liquidate the principal, they have to take the income. That's a way to guarantee the maximum benefit to the children and grandchildren. Now, to kind of conclude this part of our workshop and open up for questions, just want to offer this observation. The number one reason why people aren't prepared for retirement, most people would say, is what? Procrastination. People just don't take action. So it's important to take action because these issues are crucial, especially as it relates to the increased taxes and increased inflation we're going to see over the next 5 and 10 years. You know, you've heard that adage, Dr. Marvin, that knowledge is power. Do you agree with that?
No.
Knowledge in and of itself doesn't have any utility value. What matters is applying that knowledge. That's power. If you apply knowledge, you know, if you start to use some of these concepts and work with a professional, actually taking action and applying this knowledge, that's where you reap the benefits. You'd be surprised. Many people are familiar with a lot of these concepts. They just don't take action. So I like this admonition that, you know, this life is not practice for something else. It's not a dress rehearsal. Each of us should live each day as if it were our last, because in some cases it may just very well be. Now, I put our contact information. If somebody would like to have, you know, the articles from the Wharton Financial Planning Department, Retirement Planning Department, for Dr. Craig Babel, Professor Babel, and Professor Craig Merrill, that 10-page report, then they can feel free to contact our office. We also do anywhere from 4 to 6 lunch and dinner workshop seminars where we get into more detail on these concepts and, you know, have a more intimate setting where people can ask individual questions at the conclusion of our workshop. We have 4 to 6 of those at places like Gaslight Grill or Ruth's Chris Steakhouse, Fogo de Chao on the Plaza, Bonefish Grill in Leawood, Sullivan Steakhouse in Leawood, and other places. Jay Gilbert's Steakhouse. So if someone would like to come to one of our lunch or dinner seminars, they can contact us at the number there listed, 913-345-0505. Also, if people want a free consultation, they'd like to talk to one of our retirement planners here at Freedom Financial and just get a free second opinion, a professional evaluation. Maybe look at the idea of having a customized, mathematically correct income plan to guarantee your income for the rest of your life and have an inflation adjustment strategy to increase that income as necessary to meet pace with inflation. And looking at some specialized tax planning strategies like Roth conversion and other things as well. Look at asset allocation. Get a second opinion on whether your portfolio is, allocated in a correct way based on your objectives, your age, your risk tolerance. Then contact our office. We'd be glad to set up a free consultation, no obligation to an attendee. We just sit down for initial consultation, and whether we meet once or several times, we're not going to charge you for our customized analysis. Then if the plans we come up with make sense for that individual, then we'll help them implement them if they decide that's in their best interest. But we have a wonderful website that people are free to peruse, find a lot of valuable articles and information on the website. It's www.freedomfinancialkc.com. www.freedomfinancialkc.com. We have a couple of primary offices. We have an office in Lee Summit, one in Leawood, but our biggest two offices are College and Metcalf, 7300 College Boulevard, Suite 180 in Overland Park, and on the Plaza West building, on the west end of the plaza. That's that 16-story building they call Plaza West, or sometimes known as the Bernstein Rain Building. That's 4600 Madison, Suite 725. The Overland Park office, that tall 16-story building called Lighton Tower. We're just to the east of that, and just north across the street from Overland Park Marriott, very close to College and Metcalf. So we'd be happy to help anybody that wanted individual help and individual consultation at no charge. So, Dr. Marvin, if you like, we can open it up for questions if people have questions.
Sure, I'd like. I want to tell people that I have learned primarily what I know about finances from Paul. Now, I've been around many years, practiced all those years, and I didn't see the light of thinking ahead. I was a procrastinator because I didn't know where to put anything. I wish I, 10, 15 years ago, had met Paul. I'm telling you that from my heart. It would mean a lot more to me and my comfort. I now have comfort, thanks to Paul, that I never had before. And when you're that comforted, you don't have anything to worry about. You can sleep and sleep and sleep peacefully. Anyhow, that's an asset. If anybody has any questions, be sure and type in where it says type message here, and Paul will be more than happy to answer any questions. Do you have any comments, Paul?
I don't have any particular comments, but I'm absolutely convinced that what the decisions people make about how they allocate and design their portfolio, their nest egg, for the next 5 to 10 years are going to be absolutely crucial. Just as they've been crucial over the last 10 years, there are some people that have maintained their portfolios and have kept ahead of inflation using the kind of retirement planning concepts we've talked about tonight. There's many others that didn't have the benefit of that kind of help and have lost significant amounts of money over the last 10 years. They actually have less money now than they did 10 years ago, but because of inflation, they really need to grow their portfolio, not shrink it. So these concepts, I think, are going to be more important going forward than they've been in the past, because I'm convinced, like most professionals, that inflation is going to be a huge problem in the years to come. And we know taxes can go nowhere but up with the kind of deficits we're running. So I think it's important to address these tax planning strategies and address this asset allocation issue so that people will be secure in the coming years.
Absolutely, and I'll tell you, from my experience, I would recommend everybody touch base with a planner like Paul to find out just where you are. Because I have many friends that have lost 50 to 60% of the retirement income. Talk about scary when you're retired and have no way to get that back. Losing 50 to 60% can be the most demoralizing, depressing thing you've ever experienced. I'm sure happy that I don't have to look forward to that now. I feel secure and safe but doing the things that I've found from Freedom Financial.
Thank you, Dr. Marvin. I appreciate that.
Well, I appreciate you, believe me. I don't see any questions.
Doc, there
David?
are. Yes, sir. There are some questions. If you would scroll down some more, if you click on the questions box.
Oh, questions. Okay.
Yeah.
Okay. I don't have a question. But, oh, yes, here it is.
Actually, you could undock that question box by clicking on to the right. You see a cross.
Yes.
Next to that, to the left of that, is like a small button that you can click on. That undocks. Puts in the center.
Okay, now I see some questions. All right.
Then you can expand.
Okay, yeah.
You can expand the box by pulling on the edges, and you can actually see the whole question better if you.
Oh, here's something. We may have had a technical problem. I can hear the speaker, but the slides are not changing. Is that my problem, or is it just not changed from the financial? Oh, wow.
No, it worked, Paul. The same person noticed that.
Okay.
Yes.
This sounds too political. Are we coming to talk about personal
Retirement.
Personal. Well, the kind of deficit the kind of financial problems we're facing are not political problems; they're financial problems. I don't blame one party or another more. I see equal problems in both the Republican Party and the Democratic Party. Neither party has acted responsibly when it comes to spending. Either party has been in a posture of spending way more than we collect for many, many years. And so this entitlement crisis, the Social Security crisis, Medicare crisis, is based on, for example, Social Security. The reason we're in deficit right now, spending more in payments than we're collecting in taxes, that's partially because Congress has been spending as much as $100 billion a year on other priorities instead of escrowing those funds for Social Security Trust Fund. Had they been escrowing those funds properly, we wouldn't have a crisis today. So both Republicans and Democrats are guilty of kicking this problem down the road and spending money that should have been escrowed for Social Security. So I don't want to be misinterpreted that this is a Republican problem or a Democratic problem. It's an American problem. And we have
when it's your pocketbook, it's neither Republican or Democrat. You know what I mean?
Well, I agree, but I just think that politicians in general are so remiss, so reluctant to address these issues head on, and I think that's why we elect them, is to deal with these problems forthrightly. And I just don't think we've been getting that from either party.
I have another question. What is it? We are not in Kansas City. Can it be done long distance?
We can certainly do phone consultations, absolutely. And then if it's something that it's too far distant to follow up, then we can recommend a good firm in your area. But we can start the ball rolling and are happy to do that, to do initial consultation by telephone or by Skype. We do video conferences too. And then if it's more convenient, we can find a good retirement planner in their neighborhood and are happy to do that.
Okay, very good. What do you think about buying gold as a way of protecting assets?
Well, the wisest sage, one of the people that I just have a great deal of faith in, there's an institutional money manager, a firm called Global Financial Private Capital. They manage closed-end funds for institutions like Charles Schwab and Raymond James and others. That chief investment officer believes that it makes sense to have 5%, no more than 10% in gold as a hedge against, just as a safety hedge, and perhaps a hedge against inflation. But his opinion is most of the huge run-up in the price of gold over the last several years has already occurred. He doesn't think there's a big upside going forward, And in fact, if you study the rate of return on gold over, say, a longer period like 20 years, it doesn't even keep pace with inflation over the last 20 years. But it's also not a horrible thing to have in terms of a hedge, because we are in volatile times. So he does counsel maybe 5%, not more than 10% in a portfolio can be in gold. His own recommendation is 5%.
How would they do that, Paul? Buy the coinage of another country like Austrian francs or Swiss francs? I understood that the government can't recall that kind of gold, and they can recall all others. Is that true?
That is true, and there are firms that deal specifically in gold coins, gold bullion, any kind of even gold stocks, gold mining stocks, things like that. But I think that is the best strategy, because you're right about the U.S. government's ability to recall U.S. gold coins.
They've done it twice before.
Yeah, that's true. So, dealing with a reputable gold broker-dealer would be the way to pursue that.
And would it be best if you bought the gold coins to dig a hole in your backyard, or put it in your safety deposit box in the bank, or what would you recommend?
Well, not being a gold expert, I just know that the quality, the price of those gold coins is partially based on how close they are to mint quality. So I definitely put them in a protected environment like a safety deposit box, or perhaps, I think a safety deposit box above other options. But you want to protect the quality of those coins, the condition of those coins, because that's part of their resale value.
Great.
If you're dealing in coins that are defaced or look like they're aged, I mean, sometimes you have a numismatic value that goes beyond the price of gold. You can kind of double your returns by dealing in rare gold coins. And then the quality of that, how close to mint condition, those kind of factors start to matter.
So we have three: Austrian, Swiss, and South African Cougarans.
Well, I'd sure be going Swiss if it was me.
Yeah. Okay, I have another question. What states have the best rates for long-term care?
I haven't noticed a huge difference state to state in long-term care rates. I have noticed a big difference in companies. Kiplinger's, out of 108, this goes back, it's about 3 years ago, Kiplinger's looked at 118 different long-term care companies. Many of these companies have entered into the long-term care marketplace to issue long-term care insurance policies in the last, less than 10 years. Kiplinger's narrowed it down to 6 that they endorsed. And the reason they chose such a small number, they wanted insurance companies that had actually been paying claims for at least 15 years. Actually underwritten the policies and suffered claims, paid claims, so that they've underwritten the policies correctly. They also want companies with assets in the billions, because if you buy a long-term care policy in your 60s and you're not going to need care or benefits from that policy until you're in your 80s, you need a company with billions of dollars of assets, a very high financial rating like A or A+, so that 20 years from now that company will be there to deliver for you when you need them to. So A-rated companies with billions of dollars in assets with paying claims for 15 years or more, that entails writing policies for at least 20 years or more. That's a very small group. And I'm not going to advertise for any one company, but there are 6 that Kiplinger's, and I'm sure you could procure that from kiplingers.com, or we can share with you on an individual basis, but I don't want to turn this into an advertisement. There are 6 companies in particular that they recommended, based on their stability, based on the fact they've underwritten policies for 20 years or more. These are the companies that can say that for an individual policyholder, they haven't had any rate increases for that individual policy. Once you start a payment plan, that premium's not supposed to go up. And if they've underwritten the policy properly, that will work. Now, the majority of the states in the last couple of years have started these partnership programs, Dr. Marvin.
Right.
If you spend, I'll use an example. Let's say your long-term care policy pays out for you $200,000 in benefits. Well, as a reward or an incentive to get more Americans to plan for their long-term care costs instead of transferring that burden to the government, they've set up these partnership programs where if your plan pays out $200,000, then the state will pay out an equal amount. After your $200,000 has been spent, let's say that exhausts the benefits under your policy, the state will pay out an additional $200,000, and your family doesn't have to use their assets for that second amount. So they kind of match what you spend. You spend your benefits first, and then the state will match that. 35 states at present have that, and I predict in the next couple of years that nearly every state will have it. And that's a great way to create an incentive for people to do some private planning, because the state will match what you're doing with an equal payment from the state. And then you don't have to use up the rest of your savings and assets for long-term care.
Your next question. Are your generous offers available to people out of the area? Can you recommend planners in other states? And thank you for your presentation. That's all in that question. And you've answered part of it. Go ahead.
Yeah, I can, like I said, we're more than happy to do telephone consultations to kind of get the ball rolling. And then there is a network of over 200 firms. One of the organizations that I participate in, a member in, we have over 200 firms around the country that we can refer to. And hopefully one of those firms would be close enough for you to take advantage of. If not, we, with a little bit of internet research, could find retirement planners that have good reputation that you could meet with in your neighborhood. But we're happy to start that conversation and kind of get you, a free second opinion and get you started in the right direction, and we're happy to do that. And it's a pleasure to be part of this. I really believe in what David and what Dr. Marvin are putting together here, discussing important issues that affect all of us. I really think that's a noteworthy, webinar format. I appreciate them inviting me to come.
Makes me sleep a lot better being already done and have all my planning done. The next question is, where is the address to request a 10-page report from Wharton?
Well, probably the easiest way, quite frankly, is to send. I'll give you. I see I didn't put out the email address. We left a phone number, but I wonder if they'd like to have an email address.
Yes, I think they would.
Send it to Paul, P-A-U-L, at Freedom, KC, which stands for Kansas City, .com. Paul at freedomkc.com. Short and sweet. If you request that report, we will certainly mail it to you at no charge.
I may request it again. I've a printed copy of it, but I have some people that I sure feel would probably benefit by having that.
Well, you're welcome to as many as you like, of course.
Okay. What do you think of the program by Ray Lucia? And can you recommend a really simple, basic book to help me understand all this better? I feel very ignorant and am starting from the bottom. That was me, Paul, so you can address that. I mean, well, that's the way I felt.
Let's see. I'm trying to get to that, trying to find that question so I can read it.
What do you?
I think I'm almost there. Ray, I was trying to read the name of that author again.
Ray Lucia, L-U-C-I-A.
You know, I can't state that I have close familiarity with Ray Lucia. I've heard the name, but I really I have no reason to. I have nothing, no information that would either endorse it or not endorse it. Simple, basic book. Tell me a sentence. Oh yes. Well, you know, there are a couple. Let me look on my bookshelf here. Just one second. I'll read those to you. The title. One moment, please.
He has sure helped me. I'm reading about 5 books recommended by him because I had a long ways to go to start at zero. As a physician, I paid no attention to the planning of the future after I retired. But thanks to him, I feel very confident right now.
A couple of books that I like that are kind of primers for folks that want to get started learning more about retirement planning. It's a basic book. It's well written. It's very popular. Susie Orman has a book called The Laws of Money, The Lessons of Life. The Laws of Money, The Lessons of Life by Susie, S-U-Z-E, Orman, O-R-M-A-N. And the subtitle is Keep What You Have and Create What You Deserve. So that's a great book. The other one that I found real insightful about mutual funds, and of course our money management team at Global Financial, they tend to prefer exchange-traded funds because the fees are about half. The problem with mutual funds is the fees are just too high, and that helps to lower your overall rate of return. This book is called The Great Mutual Fund Trap, and I think it's a little more difficult read, not as easy as Susie Orman, but if you want to learn about mutual funds and other instruments like variable annuities, this is authored by Gregory Bauer and Gary Gensler. This book is endorsed by Arthur Levitt, former chairman of the U.S. Securities and Exchange Commission, John Bogle, the founder of Vanguard Group, Lawrence Summers, former Secretary of the Treasury. So this is actually a pretty insightful book, The Great Mutual Fund Trap by Gregory Bauer, B-A-E-R, and Gary Gensler, G-E-N-S-L-E-R. So those are a couple of good primers, particularly I think Susie Orman's book, because it's very basic. It's a great place to start to learn more about these concepts.
Okay. Can you recommend the best state to retire in where we can get the most for our money? Arizona, Texas, Florida, etc., especially if we don't have a lot of money after retiring?
Well, you know, I think that probably between those three, it depends on where you locate in Arizona. There are some modest communities in Arizona where the cost of living isn't as high. The same could be true of Texas. I think Florida is kind of tough right now if you don't have a lot of money. For those who have some assets, you can sure pick up some retirement homes in Florida at an incredible discount vis-a-vis 3 years ago. I had one client go down there and pick up about a $400,000 property for $200,000. So, you know, Florida has I mean, the real estate market's very depressed, so you can sure pick up some bargains. But cost of living wise, I tend to think either rural parts of Arizona or Texas. You know, Texas has no state income tax. So Texas seems to be a location for some of our clients who have more modest means. They seem to be doing very well. And of course, the climate's more agreeable than perhaps here in the Midwest. You don't have any tough winters or anything like that. That saves you some enormous heating bills. I tend to lean a little bit more towards Texas myself for a modest retirement lifestyle, where you can live comfortably and not spend a lot of your savings.
I also, and not that I have 4 grandkids that live there, but it is all you say. Now the next question is just buckets of money program.
Well, that buckets of money program, that probably refers to a strategy where you have layered accounts or laddered accounts, and you have one account that you may create to generate current income immediately, and that usually the format is to generate an income stream for 5 years. You may set up as many as 5 or 6 of these buckets, or 7, depending on your age at retirement. Let's say you wanted a 25-year plan. So you'd have basically 6 buckets, 6 accounts, and the first account turns on an income stream immediately for 5 years. And if it's non-qualified money that you're using, not IRA money, you have something called the exclusion ratio, where the vast majority of that income, typically over a 5-year payment, about 94% of that income stream will be tax-free. Then at the end of the 5 years, the second account, which has been growing and increasing in value for 5 years, suddenly you turn on that income from that second account. The first account, all the assets are gone, by the way. You know, you spent all the assets, principal and interest. Then you turn on the income for years 6 through 10, and then those assets are spent too. Then you go to the third bucket, turn on that income from years 11 to 15, the fourth bucket from years 16 to 20. The fifth bucket depends on how, you know, if we're going to 90 or something, it's either the fifth bucket or the sixth bucket, depending on how many years you write the plan for. That is the recovery leg. That account is the last bucket, or the last account is not designed for income. It's designed to recover the entire amount of the principal you started with. So it's a mathematically designed plan so that you have the same amount of money as you started with, but you have a plan that guarantees your income stream. You know exactly what that income is going to be, and you increase that income systematically to keep up with inflation. So it requires some sophisticated software to design the plan properly, but we do that all the time. You have 5 or 6 accounts and designed to create 20 or 25 years of income. And at the end of that, for the estate, you have the same amount of money as you started out with, or depending on the rate of return, perhaps a little more. But at no point during that 20-year plan or 25-year plan is your portfolio value worth less than when you started. But it does create income for the rest of your life. Now, the recovery amount is worth a little less in most cases than where you started because of inflation. Most people don't have enough money to generate a plan where you actually grow your money net and have inflation-adjusted income for 20 to 25 years. There are some that do, but in many cases you just end up with the principal you started out with. So you have a decent amount to pass on to your loved ones, your beneficiaries. So when I hear the word bucket plan, that's typically kind of a slang word to describe laddered accounts.
Okay. Michelle says, yes, I'm a nurse and they just don't teach us anything, and I can amen that because I'm a physician and they never taught me one thing about financial investment.
Well, and that is so true, and I think it's true certainly for nurses. Another demographic is teachers. Teachers have 403Bs, but they seldom get any help at all as to how to allocate or how to properly grow that money. No assistance on how to make those choices each year. The same can be true from so many employees on 401Ks. I honestly think that that's a missing element. I mean, think about it in high school and in college. But in high school, how many people are not going to have a budget, a monthly budget to deal with? How many people don't need to plan for retirement? I mean, basically, unless you're on medical disability, most everybody's going to have an earned income of some sort. And so I think it's a missing element of our high school education. I'm not criticizing trigonometry, but we have some courses that you wonder, am I ever going to use, some of these formulas ever again? I'll tell you one thing you'll always use is basic financial planning, retirement planning concepts. So I think it's a missing hole in our educational system. And I think our whole country would be improved if we added that to high school curriculums. And I think even a required curriculum for college. It's a basic financial planning course for everybody. And so I agree. I commiserate with the lady who's a nurse because thank God you're a specialist in providing care. I've been to the hospital once in my life at St. Joe Medical Center, and thank goodness for the expert staff, the expert nurses there, and doctors that took such great care of me. You have very specialized knowledge, but still, it's lacking in most educational curriculums. We aren't taught these very important concepts, and we suffer quite a bit as typical American. We suffer from a lack of knowledge. So that's what's helpful about a webinar like this, is we can start to begin to build that store of knowledge. So I'm thankful to have the opportunity to help do that.
Well, the next comment is thanks by the same lady, the nurse. This has been very informative. Another one, amen. So
well, I'm glad I can help, and I do look forward to the webinar on May 11th. And on that particular webinar, we'll focus more on a couple of topics. One is, what strategies can a typical person utilize to guarantee income throughout their retirement, to set up now, whether you're pre-retiree or retired, create a plan where you've got a guaranteed income stream and the ability to adjust that income as necessary for inflation. A guaranteed income plan that is absolutely going to work, where you know what your income is going to be and you don't have to wonder about it. You have a guaranteed plan to do that. Number two, what are the nuances? What are the things we have to look at as we examine the issue of should I or should I not convert my IRA account to Roth? There's 7 different questions that have to be evaluated mathematically before we make that determination, before we reach that conclusion. But understanding what those questions are and understanding all the nuances of Roth conversion. For some people, it's an absolute home run. For other people, it's just not appropriate. So it's all in the details of your age, your expected longevity, your tax bracket, the income you need now as you retire versus later. These are all some of the issues we have to look at. So I'll look forward to that seminar on the 11th. We'll get into those details at that time.
Sounds great. Sounds great. Well, I tell you, I don't have any further questions here. And David, do you have any questions?
No, I just want to say again, thank you so much, Paul. This has been very informative, and you've managed to take a complicated issue and make it very, very simple and straightforward. So I really appreciate you doing this.
Well, I applaud you what you're doing, because I think that scripture, "My people perish for lack of knowledge," that's certainly true. And I think in a whole other area, we have to be well informed about all the issues that we face so that we know how to work together to solve them. We have some very serious challenges. I think we can meet them, but knowledge is where it starts. And so what you're doing is magnificent, I think.
And I want to correct one thing you said. It isn't David and I doing this. The big shots are David and Sherry Platt. And she's not on here now, I don't suppose. But
No,
anyhow, Sherry is
Well,
a big
David
part.
Ajabadi and Sherry Platt, yeah, they're the ones doing this, right?
Right. I'm just a hitchhiker.
Yeah, well, we're just helpers, Dr. Marvin.
Yeah, that's all.
and we really appreciate all that Dr. Marvin has been doing. And I have to admit that at first I wasn't sure whether this would fit in our whole philosophy about finances and taxes. And then when he and Ordine, his wife, explained it to me, I was like, of course, this absolutely is necessary. And I'm glad we went ahead with this. So we're looking forward to your webinar on the 11th.
All right, great. Thank you, David. I appreciate that. I was impressed. You were once an oncologist, and now you've chosen to work in this area of, promoting knowledge. I just think that's magnificent.
Well, thank you. It's a huge sacrifice, but I mean, hey, you've only got one life to live. You got to make it doing something you believe in, right?
Make it count, yeah.
Make
Amen.
it count. Yep.
I really appreciate you, Paul. Thanks so much again for doing. When I first asked you about this, I didn't know whether you'd be interested or not, and I was so happy when you said, of course.
Well, if it's a way to give back, I've been so blessed. It gives me an opportunity tonight to give back a little, and I'm very thankful for that. I appreciate you asking me, Dr. Marvin.
Well, thank you.
Thank you.
I appreciate all you've done for me.
All right.
You know that I'm pleased to do that for you, of course.
Okay.
Absolutely. Sorry about that. Well, we'll end it here, and folks, the recordings will be available after the webinar. Thank you for joining us, and we'll stay in touch. God bless and have a
Good night, everybody.
good night.
Good night.